Good morning, guys. It is Thursday, January 4th, 2024, and it's a very special episode of Bathrobe Business because I'm fresh out of the shower. I'm in my clothes. I'm not in my bathrobe because I'm late for work, so I'm going to rush through this because I got to be out the door in less than 5 minutes. Okay, so there's actually a lot of news stories I want to talk to you guys about today. Jobs and inflation seem to be the biggest ones. Now, I'm going to report a couple pieces of information to you here, and I'll have you make your own assessments of it, but then I'm going to tell you what my opinion is. So, according to ADP, private payrolls increased by 164,000 in the month of December. That's 101,000 jobs higher than the 101,000 in November, and better than the 130,000 estimate. So, in November we added 101,000 jobs. In December we added 164 on top of that. The estimated amount was 130,000 for the month of December anyway. So, payrolls crushed it by 34,000. This was due largely to a rebound in the hospitality sector. So remember last month when I reported these numbers to you, it was hospitality that was mainly lacking. Hospitality and leisure were what drove down those numbers because they were still above estimates, but they came in lower than what was anticipated as far as like record breaking. Now this month it seems that it's back. So hospitality and leisure is back, and that sector alone added 59,000 jobs. So the next interesting facet about this is the pace of earnings growth decelerated with jobs staying. I don't know why I'm being so dyslexic today. The pace of earnings growth decreased, with jobs seeing an annual pay raise of 5.4%, while job changes saw an increase of 8%. So in other words, if you stayed at your job, you probably got a 5% increase. If you left your job and went somewhere else, you got an 8% increase. And hospitality specifically had an annual growth of 6.4%. So that's a yearly growth. So this is why I think the numbers are bad. We're still seeing a lot of inflationary pressure here. Not only are we beating estimates on the number of jobs that are coming in, we're also beating estimates on the fact that inflation is driving these wages up. So just staying at your job, you saw a 5% increase in wages. And if you change jobs, you saw an 8% increase in wages. Now, the 8% is the interesting facet because there are still more jobs open than there are applicants applying. So in other words, if you change jobs, which you can do very easily right now, you can get an 8% pay bump, and that little carousel just continues. So I don't think as long as that jobs openings stay high, as long as there's more jobs open than people to fill them, you're going to have inflation. So that's what I garner from this information. I know I stumbled through that very heavily, but that's what I wanted to report, was the fact that despite the fact that, the market is slowing, there's still more jobs open than there are people applying, and just by switching jobs, you're going to get an 8% annual growth. The next major story is the Biden administration and the CHIPS Act. So months and months ago, I reported how we were taking advantage of the CHIPS Act here in Utah, with Texas Instruments building an $8 billion facility down in Lehigh. Now they are announcing another $162 million to expand computer chip factories in Colorado and Oregon. The incentive includes $90 million to improve a plant in Colorado Springs and $72 million to expand a factory in Gresham, Oregon. So another inflationary pressure. We're moving a lot of stuff out from overseas, right? This has been the trend of the Trump administration and now the trend of the Biden administration. And no matter who wins the next election, it's likely going to continue. We're entering a very adversarial relationship with China. And even outside of that, a lot of this is now deemed a point of national security. As you'll remember, a couple of weeks ago, I reported how U.S. Steel is in a big controversy right now because they're planning to sell to Nippon Steel, a Japanese company, and many are citing national security as a reason to block this deal. So we've become very, very protectionist over the last two administrations. And actually, if you look closely, a lot of this started even in the Obama administration, but in a much, much hushed tone. There was already some talk of, bring back jobs. And actually, during the Obama administration, there was more domestic manufacturing than any administration prior, going back several administrations. So this is a trend that is continuing, and this is another one that is going to be driving inflation. Because if you're increasing jobs, if you're increasing domestic production, not only is local production more expensive, but you also have more jobs, more openings, more people to fill positions. Next major story is Apple. So Apple is part of this new term. I used to know FANG, but I guess FANG isn't in trend anymore. It's the Magnificent Seven, which is like Apple, Alphabet, Amazon, Nvidia's in there. There's a bunch of those big monster mega cap stocks. So Apple gets a second downgrade, this time by Piper Sandler, citing again iPhone sales and the valuation. I think this is appropriate. I think this is right, and I think this is a result of high interest rates. This is why if you watch my channel, I always talk about high interest rates, high interest rates, high interest rates. We need high interest rates. They are a good thing. They are not a bad thing because it realigns the market and it causes these companies to become more lean and efficient. Apple was not worth the valuation. Remember, we're talking trillion-dollar companies, right? With no real manufacturing of their own. Let's be honest. Everything in Apple is manufactured by Foxconn, and yet they have a trillion-dollar valuation. It doesn't equate. And you could say, well, it's their app store, it's their intellectual property. Sure, fair, all fair. However, there's other companies that have massive intellectual property. If you're talking about movie studios, they have massive intellectual property because they have property that goes back 100 years. They don't have trillion-dollar valuations. So this is the market realigning. And I want this to continue. So that's why I'm always advocating higher interest rates, because if you can get a bond that's giving you a better return than a stock, why wouldn't you get the bond? This causes that little company to either be valued correctly or to innovate and grow. Last story is pretty much echoing what I've been talking about in this video and in previous videos. So minutes from the Fed meeting show that several Fed chairs, several members have said that they do not see a path forward for rate cuts. So this is outside of Jerome Powell. This is the board itself. Many were saying they do not see rate cuts in the future, and that they're actually seeing the potential for more raises if necessary. And more or less, they're saying we should stay where we are. This is pretty on par with what I think, and this has been echoed by multiple Fed members now over the last few weeks. We've reported, I think, Philadelphia, New York, all have said that, whoa, we never said rate cuts. And so that is, I think, likely to continue. I think that we are going to be staying at the same level for a minute. That's the last story of the day. Sorry I got to run. I will see you guys tomorrow. Have a great and productive day.